Hello viewers, in this video I'm going to show you how to prepare 3-column ledgers. First of all, let me tell you the main difference between 3-column ledger and T-column ledger. In T-column ledger, you will get the balance at the end of the accounting period or at the end of the month. But over here, in 3-column ledger, you will get your balance every time you update your accounts. So you might have questioned why it is called 3-column ledger. So you see, you have three main columns: debit column, credit column, and balance. So because of these three main columns, this is called 3-column ledger. This method is also considered as modern way of preparing ledger. So let's see how it works. So just like 3-column ledger, we need to focus on the similar or same issues. We can see bank is the common account in all three journal entries. Bank is here, bank is here, bank is here. So it means to prepare a ledger of bank, we need to focus on all these three journal entries. We have to prepare a different ledger for different accounts. So let's see how many accounts we have. So we have bank 1, capital 2, equipment 3, accounts payable 4, rent 5. So we have 5 different accounts. So it means we have to prepare 5 different ledgers for 5 different accounts. Okay, so let's start with bank. Okay, so bank is also called as cash at bank. So it means like cash at your business bank account. Okay, so balance BD, it means balance brought down from last month, which is $10,000. Then you can see 1st of April, capital $50,000. So you can see capital $50,000 is here. But remember, this $50,000 actually this one. So if your bank is debit, you need to write that $50,000 on debit. So bank $50,000. That means you need to write $50,000 on debit side, but under opposite account. So your opposite account, the name of your opposite account is capital. Opposite means if bank is debit, the opposite of bank account is the credit one, which is capital here. So you write capital here. So it means your bank account has been increased by $50,000 by the capital account as owner invests. So you can see you can see the balance. You need to do the balance immediately. So as soon as you enter capital under capital $50,000 debit, it means actually bank $50,000 under capital account. So you can see your balance before was debit $10,000. So that means your business got $10,000 money in their bank account. So debit plus debit, and if you see debit and if you see debit, so debit plus debit equals to, so it means debit plus debit equals to debit. So you have $10,000 debit, then you have $50,000 debit. So $10,000 plus $50,000, you have $60,000, which equal to debit. So your balance $60,000. So it means right now you have $60,000 balance in your bank account. So positive balance. So now we can see equipment $10,000. How we got the $10,000? So bank, you can see $10,000. So we put actually that $10,000 here, and the different account, I mean the opposite account would be the account for the particulars. So $10,000 you got because your bank is credit, so you write $10,000 as credit. The opposite account of bank is equipment, so you write equipment. So now you can see your $60,000 is debit, then you see $10,000 is credit, so it means debit 60,000 and credit 10,000. So when you see debit and credit, you need to minus, you need to subtract the amount. But remember, if your debit amount is greater than the credit amount, then your balance amount would be debit. So over here your debit amount is 60,000 and your credit amount is 10,000. So 60,000 minus 10,000, you have 50,000, but 60,000 is greater than 10,000. That's why your balance amount would be debit. So similarly, the next one, your bank is credit. So again, bank is credit. So opposite amount you write in the particulars as rent. So your $50,000 is debit. Now you have $1,000 credit. So $50,000 minus 1,000, you get 49,000. Your debit account, your debit is way greater than your credit. So that's why your balance would be debit again. But remember, if your credit balance is greater than your debit balance, then your final balance would be credit. So see, this method, every time you update transaction, it tells you the balance. So business or owner invests $50,000 in the business, it becomes $60,000. So business starts with $10,000, then owner invests $50,000 in the business, it becomes $60,000. Then business bought $40,000, but business paid $10,000 on cash, so $60,000 becomes $50,000 as business paid $10,000 for buying equipment. Same way, business paid $1,000 for the rent, so $50,000 becoming $40,000. Okay, now let's prepare the ledger for capital account. So you can see John invested $50,000 in his business, so bank debit, capital credit. So you don't see capital in other journal entries. That means we just need to focus on this journal entry. So over here we can see $20,000 brought down from last month, and then we can see capital account has been increased by $50,000 as business, as owner puts or invests money in this own business. So you can see the journal is bank debit, capital credit. So you remember we're doing the ledger of capital. So capital is 50,000, credit, so 50,000. So now we can see capital is 50,000, which is credit. So you need to write under credit. So 20,000. So you can see credit plus credit. So you can see the credit plus credit would be credit. Similarly, credit, and if you see debit, then it will be minus. But remember, if debit side is greater than credit side, then the balance would be debit. If credit side is greater than debit side, the balance will be credit. Similarly, if debit side is greater than credit side, the balance would be debit. So this is the way you can prepare the ledger for other three accounts, which is equipment, accounts payable, and rent. So remember, in 3-column ledger, you will get balance every time update your accounts. Whether it's debit or credit, every time you update your accounts, you will get the balance. So this is the main advantage of preparing or having a 3-column ledger. Thank you.